Today, I like to talk about the iShares US Technology ETF, ticker symbol IYW. iShares is a collection of exchange traded funds, also called ETFs, managed by BlackRock Investment Company. We're going to the Seeking Alpha's website and read more about this fund. IYW is an ETF that, according to iShares, seeks to track the investment results of an index composed of US equities in the technology sector. The benchmark index that IYW most closely tracks is the Russell 1000 Technology Index. The key peer competitor ETFs that most closely match IYW's objectives are the Vanguard's Information Technology ETF, ticker symbol VGT, Invesco's QQQ ETF, ticker symbol QQQ, and Technology Select Sector SPDR ETF, ticker symbol XLK. While VGT and XLK exclusively contain information technology sector holdings, IYW and QQQ are not constrained by this sector and include communication sector holdings. IYW has enjoyed superior performance compared to VGT, QQQ, and XLK in both 1-year and 10-year time frames. While IYW has led big tech ETFs over most time periods in performance, the fund has two primary downsides. The first is its expense ratio. With a 0.4% expense ratio, IYW is the most expensive of compared big tech ETFs. Not surprisingly, Vanguard's fund ties for the lowest expense ratio at 0.1%. However, IYW has outperformed other lead tech ETFs even when factoring in the higher expense ratio. The other downside for IYW is its low dividend yield at 0.4%, compared to other peer ETFs that have a dividend yield between 0.5 to 0.9%. IYW also has the lowest 5-year dividend growth. When factoring in higher expense ratio and lower dividend yield, IYW has still historically provided greater returns to investors. The Morningstar rating for this ETF is 5 stars. Morningstar has awarded the fund a silver medal. The year-to-date return as of today, August 12, 2024, is 13.93%. Each share is around $139 as of today. Like from the website Seeking Alpha, the article talked about the expense ratio, which is 0.4%. Looking at the performance, let's look at the total return cumulative total return percent. For 5 years is around 212%. For 10 years is around 571%. And since its inception date is 497%. Let's look at a hypothetical graph. We can do like a 10-year window. So if you put a $10,000 here in 2014, it's growing here, and as of today, in August 2024, is around $60,000. Now let's look at it. It also gives dividend quarterly, so every 3 months it gives a small dividend. The fund inception date is May 15, 2000. It has 140 holdings. Now let's talk more about PB ratio. The PB ratio of this fund is 9.25. The price to book value, which is the PB ratio, is a fundamental measure used to determine if an investment is valued appropriately. The book value of a company is a measure of how much a company's assets are worth, assuming the company's debts are paid off. Each holdings, the PB is the latest closing price divided by the latest fiscal year's book value per share. From the Investopedia's website, it talks more about the PB ratio. The price to book PB ratio considers how a stock is priced relative to the book value of its assets. If the PB ratio is under 1, then the market is thought to be underpricing the stock, since the accounting value of its assets, if sold, would be greater than the market price of the shares. Therefore, value investors typically look for companies that have low price to book ratios, among other metrics. A high PB ratio can also help investors identify and avoid overvalued companies. The PE ratio for this ETF is 39.26. The price to earnings, the PE ratio, is a fundamental measure used to determine if an investment is valued appropriately. Each holdings, the PE is the latest closing price divided by the latest fiscal year's earnings per share. From the Investopedia's website, it talks more about the PE ratio. The PE ratio is one of many fundamental financial metrics for evaluating a company. It's calculated by dividing the current market price of a stock by its earnings per share. It indicates investor expectations, helping to determine if a stock is overvalued or undervalued relative to its earnings. The PE ratio helps compare companies within the same industry, for example, like an insurance company to an insurance company or a telecom to telecom. It offers insights into market sentiment and investment prospects. However, it should be used with other financial measures since it doesn't account for future growth prospects, debt levels, or industry-specific factors. As we discussed earlier, the PE ratio for this ETF, IYW ETF, as of today is 39.26. Now, let's look at Microsoft's PE ratio as of today is 35. Apple is around 33.63. Nvidia is around 67. Tesla is about 57. And Vanguard, the S&P 500 ETF is around 27. And the Charles Schwab's dividend ETF, SCHD, the PE ratio is around 15.26. All right. Let's look at the holdings. It has Apple, Microsoft, Nvidia, Meta, which is Facebook, Instagram, has Broadcom, Google, Adobe, Salesforce, AMD, Oracle, Texas Instrument, Intuit, Lam Research, Micron Technology, etc. And some others are Palo Alto Networks, Intel, Palantir, CrowdStrike, Marvell Technology, Workday, DoorDash, Microchip, Snowflake, Cognizant, supercomputer, microcomputer, Dell Technology, Hewlett Packard, Leidos, Skyworks, Pure Storage, VeriSign, Manhattan Associates, Okta, Zoom Video, DocuSign, Lattice Semiconductor Corp, also has Dolby Laboratories, Zoom Info, Trump Media Technology Group, and Astera Labs, etc. So if you come to this iShares website, you can look at all the holdings. But these holdings are subject to change. So that's the purpose of having an ETF. So you can sleep better at night. So you don't have to think about if you choose a single stock, then the price will go up and down. It's very volatile. So it's hard to for some people it's hard to sleep at night. So that's why you want to choose an ETF which has like a lot of holdings in there, and it does something called self cleansing. So here it says over here on the website the holdings are subject to change. That means it's called self cleansing. So what is self cleansing? Let's read from here from this Reddit website. So self cleansing is pretty much what it means. That here this person explained it about self cleansing. Over time, some companies drop out and others are promoted from the tier below. That's called self cleansing. Usually, before a single company might go bankrupt, it would get kicked out of the club or the index, and the new member joins, like a new company joins. So the holdings are automatically updated, and companies drop out for other reasons, such as selling of divisions, etc. So that's why you don't have to worry about, volatile, worry about like going up and down at night and stuff like this. You can have a proper sleep at night. So that's why you want to try to invest in ETFs. So if you want to learn more about this ETF, you can visit the iShares website by BlackRock, and the ticker symbol is also again is IYW. Here's more about the exposure breakdown. It has software services, semiconductor and semi equipments, tech hardware, media and entertainment, commercial and professional services, consumer services, capital goods, financial services, etc. And I went over a couple of the stocks in this ETF. Again, thank you so much for listening to me today. My name is James, and thank you again.